We have just talked about the direct method. Now let's look at the indirect method. For the indirect method, we start with accrual-based net income, which is taken from our income statement, and make adjustment to derive cash flow from our operating activities. So there are three kinds of adjustment to net income. The first is items that affect net income but has no cash effect. For those items, we need to back them out from net income. Examples are depreciation, amortization. The second kind of adjustment are items that affect net income and cash, but not from an operating activity. So for those items, we need to reclassify them into either investing or financing activities. Examples is, for example, gain or loss on sale of PP&E. The third kind of adjustment are operating items for which income effect differs from cash flow effect. So for those, we need to adjust for the difference. And steps to make a cash flow statement under the indirect method. First, we need to calculate all of the non-cash balance sheet account change. So the change in all of the non-cash balance sheet account. And then we decompose change if necessary. Thirdly, we classify those change item into operating, investing, or financing. So, and after that, we adjust net income and finalize the statement. So this is just a brief step-by-step description, and then we're going to look at an example very shortly. And then when we are making the cash flow statement, we need to pay attention to two accounts. One is the PP&E account and the other is retained earning. For those two accounts, make sure we need to decompose those two accounts. For PP&E, we have a beginning balance. And then the increase in PP&E usually comes from purchase of PP&E. The decrease in PP&E can come from two sources. One is the sale of PP&E. The other is accumulative depreciation. So for the purchase of PP&E, and then after that, we're going to have an ending balance. For the purchase of PP&E and the sale of PP&E, both of those are investing related activity. However, for depreciation is deducted from the net income, so we need to back it out. So that's this amount, we need to back it out from the operating activity in the operating activity section. Retained earning. So retained earning, the beginning balance is at the credit side. And then the increase in retained earning usually comes from net income. So net income, that's the top line, the first line in your operating section. And then the decrease in retained earning is coming from dividend. Dividend is a financing activity. So after that, we have an ending balance. So for the change in those two accounts, we need to clarify, we need to decompose those two accounts to make sure that not all of the change are coming from one item. So for example, for the change in PP&E, part of the change may be an investing activity. Part of the change, the depreciation related, that's a operating activity. So those are two accounts to pay attention to. And then let's look at an example.